Welcome back, guys. In today's episode, I'll be sharing with you how I go about analyzing stocks. I feel like this is some important knowledge that every investor should know, and many people are intimidated by the terminology and the numbers aspect. So I've simplified this into a short list of what to look for, and I'll show you how to find them. After we go through the list and the examples, I want to talk about some news, and for some of you this may be a reminder, that may be affecting your current holdings and the economy as a whole. So stick around. Alright, so as we usually do, we're going to start off with a portfolio update. We're currently sitting at 540 and we've got 0.5 return. Now this update's more important than it usually is because this will tell you exactly why we're invested in these holdings. I'm going to tell you exactly how I came about these. A lot of people have had questions like, which stock should I invest in? Why am I invested in it? Well, I'm going to tell you exactly why we're invested in these specific holdings today. But first I want to show you guys a video of Mr. John Neff, and he's going to explain to you exactly why we picked these holdings. So let's look at it.
So the first thing is that, as he likes to say, we aren't speculators in the price movement of shares. We own businesses. And the focus is on owning the most exceptional businesses that we can find. And if you're really limiting yourself to exceptional businesses, the list of businesses that you would ever own is going to be a short list. And that's why we're incredibly concentrated. And if you've identified a great business and you've purchased it well, why would you be in a rush to sell it?
So there it is. John Neff says you want to own the businesses, you want them to be exceptional businesses, and when you do own them, you want to be in no rush to sell them at all. So what we do here is we look for dividend growth companies, but very high quality. So if you've been following this channel for the past month and a half, you've realized I've never sold anything, and I've bought, I think, 2 holdings on this entire channel in a month and a half. And I never plan on selling these. I have a very small, select few amount of stocks here that I believe in. I've went through the finances in the exact way that I'm about to show you, and I believe in them. So let's get into looking at how I analyze these stocks. Okay, so here's how I analyze stocks. If you're going to be dividend growth investing, these are at least the basics that you're going to want to know. But this is really all I use other than a couple of other data factors. So number one, I want to start off with the PE ratio to be between 10 and 40. If a PE ratio is over 40, that means you're going to be paying a little bit of a premium, a higher price for the stock. I don't think that's terrible, but if you're at least initially buying in, you want it to be between 10 and 40. Number two, the total revenue increasing. You want them, this means that you're a good company. You're always going to be having revenue coming in, and it's always increasing. The same thing with net income. Number 3 is net income increasing. You want this to always be increasing. That means you have a profitable business, a profitable company. They're making a lot of money, and they're consistent at doing it. Number 4 is a payout ratio below 70%. This is important because if a company is paying so much over what they're actually making. So if they're at 100% and they're paying all of their stockholders, 70%, they're not really saving any money for themselves in the business. If they're at 70% once or twice, over a 5-year period, that's not bad. But if they're consistently over 70%, that's trouble. And number 5, they have to be increasing their dividend. If a company doesn't increase their dividend, that might be a little bit of a red flag for something that's going on financially within the company. So I'm not going to go back to this, but just if you have to, go back, scroll back, and you can look at this as we continue on through the video. All right, so I'm going to show you guys how to find this stuff. So we're looking for the PE ratio first. The PE ratio, I'm using Microsoft as an example because they're kind of the a little golden boy for this. So PE ratio 33. So you can find this anywhere. Seeking Alpha, you can find this on, Google, anywhere. So their PE ratio is 33. Now, the next thing we want to look at, we want to go to the financials. Financials is what's really going to show you how a company is doing, how they're performing. If you've ever heard the saying, numbers don't lie, they don't. Okay, so let's look right here, their revenue. Back to 2015, it was 93, 91, but after that, it really starts to increase. That's exactly what we're looking for. When I'm looking to, invest in a company, I want their revenues to look like this. And with the net income, I want it to be the same exact thing, 12, 20, 25. They had a little bit of a slip up. I think that was 2018. And after that, they were just off to the absolute races. Next thing I want to look at is their payout ratio. So for this, we go to ratios, and we're going to scroll down and look at the payout ratio. They've been over 70% once. After that, they've been basically under 35% the whole time after, I think that's 2016 or 17. They've been under 35% this whole time. That's a great payout ratio. They're saving basically 3/4 for themselves, investing in their own company. Now we'll go to their dividends. You want their dividends to always be increasing, and you want it to be at a good percentage too. So their dividend growth, they're averaging a 9.68 increase every time they increase it. It's currently at a 0.83 yield. So let's look at it's loading the charts. Let's look at their dividend chart. You want it to always be going up like this. If you're looking on Seeking Alpha, if you're looking on Google, whenever you're looking on their dividend charts, you want it to be increasing like this, especially their year over year increasing. So you want to see it always increasing. Let's look at another company as well. Let's look at Costco. So another example will be Costco. They're trading at a 40 PE ratio, okay? That's right at the top of the line for this. So if you're looking to get into them, you're going to be paying a little bit of a premium, but guys, it's still worth it. Costco's still worth it. Let's look at their finances, revenue. They absolutely crush it with their revenue. Always goes up. Their net income always goes up. Look at that, guys. Absolutely killing it. Go over their ratios. Go down to their payout ratio. They're paying basically, 3/4, 30%, a quarter, 30% just about. And that's exactly what we're looking for with the ratio. And then you go to yield is 0.75. Their dividend grows at 13.61%. And then we'll go down and we'll look at their chart. And that's exactly what you want to be seeing. So guys, that's two of the companies that we're invested in, and they check all the boxes. So if you're looking to get into dividend growth investing, or if you don't know exactly what you're looking for, that's what you're looking for. That's where to find it. I'm on Stock Analysis. I've been using them lately. I think they're a good website to use. You can also go to the actual company's website, and they'll give you a lot of this same information, if not more. So on to the current event of the day. And I think this is just a subject that's not talked about enough. But it says here, investors' lower outlook for consumers as student loans and credit card debts pile up. Now, this is an article from Reuters, and it basically is saying that student debt is scheduled to resume. People are going to have to start paying that back. And credit card debt is basically out of control. So why does that have to, affect investors? Well, it affects investors in a couple of different ways because A, you might not have enough money to fund your account now because the average student loan payment is $500 or more each month. Also, people have credit card debt. Guys, you want to be eliminating all of your debt. And if we look at the average credit card debt by state, there's a lot of average credit card debt. What shocked me the most is here, Alaska's got the highest. I think Connecticut's second most. The Midwest seems to be keeping their credit cards in check. But guys, if you have credit card debt, you got to get that paid off so you're not paying interest. And then if we look at the student debt, oh my goodness, guys, we owe $1.76 trillion in student loan debt. And that also has interest on it. We took a pause for 2 years, and now it's time to pay it all back. And it's just been racking up. I know it wasn't accruing interest, but there is still so much money owed. And that's going to affect the economy because when it comes time to go and spend money, there's going to be less of that because people are going to be spending their money paying off all of their debts. Hopefully, people are going to be paying their student loans. People are going to be paying their credit cards off. But this isn't good. I don't think this is a very good outlook for the United States economy. If you look at this graph here, it just keeps going up, 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 up. Guys, we need this to be going down, 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 especially as investors in all of these great companies here. You want all of the national debt to go down so people have more money to spend. Okay? So if you have debt, please do yourself a favor, do everybody else a favor. Let's get all of that paid off. I'm included in that. I have student loans still as well. Let's get all of that paid off. So that's it for today, guys. Thank you.